The Australian share market is back in the black for April. It's been a wild ride since Donald Trump's erratic tariff announcements, pushing it deep into correction territory and out again. If you'd invested in the index on the 1st of April, just before Liberation Day, you'd be up by more than 1% so far. Volatility appears to have calmed here and on Wall Street. Are investors growing accustomed to the chaos? Ben Powell is Blackrock Investment Institute Chief for Asia Pacific. Ben Powell, welcome to the business.
Great to be with you.
Now, the news headlines coming out of the White House are changing rapidly, but the latest indications are the US could move to de-escalate the trade war, but China also has to come to the party. How are investors perceiving the endgame here?
So a lot going on, I think it's fair to say. Two things that strike me. Firstly, we are in a different environment, right? So I think to some degree, this volatility is something we're all going to get used to as we see sort of policy at the speed of social media, right? So that I think is something like a feature rather than a bug is going to persist, and we're all going to have to kind of relax into it as best we can. That's the first thing. Secondly, and I think really important, it seems like there are some constraints on the US administration. So a couple of weeks ago, it was unclear what was going to hold them back or whether they were just going to kind of charge forward regardless. It now really looks, Alicia, as if they are mindful of the equity market to some degree, but in particular the bond market. So obviously the US has got a lot of debt, and interest rates going up a bit too far, a bit too quick, seems to have given the administration pause for thought, and that's somewhat encouraging in a slightly busy time.
And you talk about those bond market moves. We've seen the dollar down, bonds down, stocks down at the same time, while the Fed is still holding interest rates at a relatively restrictive level. This Sell America trade is very much on. Are the moves in the markets that you're seeing reminiscent of emerging market sell-offs?
A little bit. I don't want to go too far with that thought, because the US is still a unique kind of scale of business, capital markets, intellectual universities. All of that stuff, Alicia, is still true. So I think we should be thoughtful around the question, is the US evolving? That's fair, but I think we need to be a bit careful to go all the way to kind of bracketing it as an emerging market, which it's not. But the market clearly, with those moves you're talking to, is asking the question, what are we up to here, guys, I think, and trying to think about, do we need to be marginally allocating more of our investments, maybe at the margin, away from the US and into other geographies? That's what we're wrestling with, and I think that's what the market's kind of been implying with those price movements you just highlighted.
You look at a wide range of markets. Where do you think investors are, if anywhere, are insulated from the Trump-inspired chaos?
One thing we're saying at Blackrock is having a kind of naive risk-on approach, just being long and don't touch. By the way, that worked really well, right? During the Great Moderation, after the GFC, basically up to COVID, that was the right approach. Sadly, now we think it's not. So in a much more kind of fractured, complicated world, which maybe we're all sad about, but again, as investors, we have to deal with the world as it is, rather than the world we would prefer. So we think you need to adapt and move to a much more kind of nuanced approach, really targeting much more precisely what you want in the portfolio and what you don't want in the portfolio, rather than, as I say, Alicia, having that kind of naive risk-on approach. We're going to have to all work a bit harder, frankly, and pick our spots a bit more carefully.
And with that risk-on approach, central banks were essentially underpinning that. Are they going to ride to the rescue this time?
This is a huge problem, I think, because our answer is no, they can't. And the answer, the reason for that is sort of appallingly straightforward. Inflation's too high. And Chair Powell, I think, has been at pains to remind everyone that he's got a mandate, which means mandatory, right? So some, English here, mandatory does not mean optional. It means compulsory. He can't kind of ignore one side of the mandate. Inflation, again, already too high, likely to go higher as the impact of the tariffs work through. So he is hamstrung. He is constrained by that side of the mandate. And what that means is, even if we see markets go down a bit or growth go down a bit, he can't come in as the cavalry over the hill. Central bankers are used to playing the role of superhero because they were unconstrained by inflation. Now they're constrained. That's a totally different kettle of fish.
And we have seen quite a bit of selling. Markets have been on a rocky ride. They're pretty calm at the moment. Is this the end of it? Are we at the bottom?
So the way markets work is not, how can I say, we live in the the marginal change. So I don't think we're at the end of trade tensions. That's going to run and run. But it does feel, Alicia, very importantly, that we've now moved to a world where we kind of understand that a bit better. And some of the heat has come out over the last week as we, as markets, have learned that maybe there are some constraints on the US administration. That's kind of really important and actually quite encouraging for risk. And I think that's why markets have calmed down in the last few days.
Ben Powell, thank you very much.